Good morning and welcome to TOI Japan Market Radio. I'm your host here in Tokyo, and today is December 24, 2025. This show is designed for global investors who are tracking Japan's markets or managing exposure to Japanese equities, the yen, and Japanese government bonds. Let's dive straight into today's market action.
Thanks for having me. So today we saw the Nikkei 225 close at 50,344.102, down 0.136%. The TOPIX was slightly weaker, falling 0.418% to 3,573. Interestingly, we saw some divergence with the Mothers Index, which is our growth index, up 1.583% to 2,117. J-rates also ticked higher by 0.245% to 2045.5. On the currency side, dollar-yen came in at 155.986, down 0.568%, so we're seeing modest yen strength today. Gold in yen terms was basically flat at 16,660, down just 0.12%, and crude oil edged up marginally at 58.42, up 0.069%.
So essentially a mixed session with some modest pressure on the major benchmarks, but growth stocks holding up better. Let's get into the news flow that's shaping sentiment. The first headline today is that the Nikkei 225 is consolidating above the 50,000 level amid yen strength and Bank of Japan signals that are cooling momentum. What's your take on this dynamic?
This is quite an important technical and fundamental juncture. We've got the Nikkei trading above 50,000, which is a psychologically important level and represents solid investor confidence in Japanese equities at these valuations. However, at the same time, we're seeing the yen appreciate, and more importantly, the Bank of Japan is beginning to signal a shift away from the ultra-accommodative monetary policy that has been in place for years. This creates competing forces in the market.
So essentially the equity market is consolidating while the macro backdrop is shifting. How should global investors think about the implications here?
The key issue is that the weak yen, easy money environment has been a major tailwind for Japanese equities since 2022 and 2023. A stronger yen and BOJ tightening represent a fundamental change to that narrative. For equities, particularly the Nikkei and TOPIX, further yen strength could pressure export-oriented companies because they lose that competitive currency advantage and also see lower yen-translated earnings from overseas operations. Additionally, if the BOJ continues to tighten, we'd expect higher discount rates, which could compress valuation multiples. On the currency side, yen strength is consistent with the BOJ's inflation control objectives, but it does reduce export competitiveness. And for Japanese government bond yields, BOJ signals of less accommodation typically translate into upward pressure on the 10-year JGB yield as the market prices in potential rate hikes.
That's a comprehensive view of how this consolidation fits into the broader policy shift. Now, looking at individual stock performance, we're seeing some interesting divergence today. Reports indicate that while the Nikkei advanced only marginally, around 0.02% in some sessions, Capcom surged 4.33%. What does that tell us about investor sentiment?
This is actually quite revealing. The fact that the overall index is essentially flat or slightly negative, but you have a major entertainment and gaming company like Capcom rallying over 4%, tells us that investors are still selectively hunting for quality growth stories. Capcom is a prime example of a Japanese company with strong international revenue exposure and secular growth tailwinds in digital content and gaming. This outperformance suggests that while the broader market may be consolidating or experiencing some profit-taking ahead of year-end, there's still constructive sentiment toward high-quality Japanese exporters and growth sectors.
So it's really about stock selection rather than broad market momentum at this point. On the policy side, you mentioned the BOJ signals earlier. How significant is this shift for investors who've been positioned for continued accommodation?
It's highly significant and represents a potential regime change. For years, the BOJ has maintained negative or zero interest rates and yield curve control, which kept borrowing costs extremely low and supported asset prices. If the BOJ is now signaling cooling accommodation or potential rate hikes, that's a fundamental reassessment for portfolio positioning. For equity investors, it means you need to think carefully about which sectors and companies can sustain margins and earnings growth in a higher rate environment. Financials might benefit from a steeper yield curve, but highly leveraged growth companies or those dependent on cheap financing could face headwinds. For bond investors, this means duration risk is back on the table, and we'd expect to see higher yields across the curve.
That's a critical point for global investors managing Japan exposure. Shifting back to equities, we're also seeing this happen during a period of very thin year-end trading. How much of today's price action is just holiday-related versus a genuine directional signal?
That's a great question, and it's important to separate noise from signal. December 24th falls right in the final trading week of the year when volumes are typically very light. Many institutional investors have already squared positions for year-end reporting, and you see reduced participation from both domestic and international players. The minimal declines we're seeing today, down 0.11% or 0.136% depending on the session, suggest consolidation rather than aggressive selling. This is pretty routine for this time of year. However, the broader themes we've discussed, yen strength, BOJ policy shift, consolidation above 50,000. Those are structural factors that will persist into 2026 and should inform medium-term positioning.
So the holiday factor is real, but the underlying themes remain relevant. Meanwhile, in corporate news, the divergence in performance we saw today, particularly with the Mothers Index up over 1.5%, suggests that risk appetite for Japanese growth stocks is still intact despite the macro uncertainties. Is that a fair reading?
Absolutely. The Mothers Index is our benchmark for smaller cap growth companies, and the fact that it's up 1.583% while the TOPIX is down nearly 0.5% shows a clear bifurcation. Investors are still willing to take on risk in companies with strong growth prospects, innovation, or exposure to secular trends. This is consistent with what we're seeing in Capcom and other quality names. However, I would caution that this kind of stock-specific strength doesn't necessarily translate into broad index gains, especially if the macro backdrop becomes less supportive due to yen strength or rising rates. So it reinforces the importance of active management and stock selection in the current environment.
That's a really important distinction for portfolio managers. Staying with the yen theme for a moment, dollar-yen at 155.986, down about 0.57% today, is notable. We've seen the yen strengthen modestly. How does this fit into the broader currency outlook as we head into year-end and early 2026?
The yen's modest appreciation today is part of a larger pattern we've been monitoring. Year-end positioning often supports the yen as global investors and Japanese corporates repatriate funds or square positions. But more structurally, if the BOJ is indeed moving toward tightening while the Federal Reserve is either on hold or potentially nearing the end of its hiking cycle, that narrows the rate differential between the US and Japan, which has been a key driver of yen weakness. A stronger yen has mixed implications. It's positive for import-dependent sectors and helps the BOJ manage inflation, but it's a headwind for exporters and could weigh on earnings for companies with significant overseas revenue. For global investors, it also affects the hedging decision. Unhedged Japan equity exposure gets a currency boost if the yen weakens, but faces currency drag if the yen strengthens from here.
That hedging consideration is critical, especially for dollar-based investors. Let's pull this all together as we wrap up. What are the key themes global investors should be focused on as we close out 2025 and look ahead to early 2026?
I'd highlight three main themes. First, the Nikkei's consolidation above 50,000 is a test of whether Japanese equities can sustain elevated valuations in a shifting macro environment. Second, the combination of yen strength and BOJ policy normalization is a regime change that will have significant implications for equity returns, sector performance, and currency hedging decisions. Third, despite these macro headwinds, there's still selective strength in quality growth companies, as evidenced by today's performance in names like Capcom and the Mothers Index. So the message is, remain engaged, But be selective and think carefully about how changes in rates and currency affect your portfolio.
That's excellent perspective and a very balanced view of the risks and opportunities. For those of you tracking Japan's markets regularly, we'll continue to bring you these daily briefings to help you navigate the headlines and understand the implications for your portfolios. If you find this useful, please consider subscribing and sharing with colleagues who manage Japan exposure. Thanks for joining us today, and we'll be back with another update soon.
Thanks for having me, and happy holidays to everyone listening.